Hello everyone and welcome to the revision session for consolidated financial statements for your CA Inter Advanced Accounts paper 5. Now, consolidation is obviously a very important topic. Rather, it's one of the most important topics of your advanced accounts. You are definitely going to get a 10 or a 15 mark question on this, and hence it is quite significant. Now, there's a lot of noise around consolidation on the fact that it is difficult, easy, etc. Largely, it's a process-driven chapter. So, if you kind of remember the steps properly and apply a few adjustments in order, you are getting the full marks in this chapter. So, let us run through this. What do you mean by consolidated financial statements and when do you need to prepare them? So, as per the Companies Act, a company needs to prepare its separate or standalone financial statements where the company is a separate legal entity and every separate entity is different from the company. Apart from this, a company which has even a single subsidiary, at least for your CA Inter, and in practice even a single joint venture or associate, has to prepare consolidated financial statements. Now, what do you mean by consolidated financial statements? Now, these are statements for the group as a whole, considering the parent and subsidiary to be one and the same. So when I look at Reliance Industries Limited, it has, let us say, a 70% stake in a company called as Reliance Jio Limited. In its separate financial statements, Reliance Industries Limited will just show an investment in a company called as Jio along with other investments as per AS 13. However, in the consolidated financial statements, we will break that legal barrier where we say that Reliance Industries Limited and Reliance Jio Limited are two separate entities. No, we will say that they are part of one single group, and hence what will be the combined position of both of them together. So, a consolidated financial statement is the combined statement of parent along with all of its subsidiaries. And to prepare such statements, there's a separate accounting standard called as AS 21. Now, what is largely the difference between amalgamation or absorption that we have done under AS 14 versus consolidation under AS 21? Under amalgamation or absorption, what happens is the selling company loses its separate legal existence, and as a result, all the assets, all the liabilities of the selling company actually merge or are amalgamated or absorbed into the purchasing company, and hence the land, the building, the inventory which is held by the selling company is now legal in the name of the purchasing company. On the other hand, one of the other ways in which acquisitions happen in practice is you don't really make the selling company go out of its separate legal existence, rather you maintain the separate legal existence of the selling company. Like there's Tata Motors, and then Tata Motors has a 100% stake, for example, in a company called as Jaguar and Land Rover. So JLR continues its separate legal existence, Tata Motors also has its separate legal existence, but by virtue of, let us say, the 100% stake, Tata Motors can decide what is to be done in JLR. So the entire business of JLR can be controlled by Tata Motors by virtue of that 100% stake. And as a result, if JLR has a plot of land, Tata Motors can exactly decide what it wants to do with that plot of land. Now, one can say that consolidated financial statements have to be prepared the moment we have control, and we assume that control arises on a 100% stake, which is not always necessary. Even if you have more than 50% stake in a company, or you are in a position to control the composition of the board of directors of a company, you are said to have control and the company is said to be your subsidiary. Because even with, let us say, a 60% stake in a general meeting, you can have enough clout to kind of pass a resolution in a manner you want. So if there's a land of 100 acres with, let's say, Jaguar, and you own a 60% stake, that does not mean that you can take decisions only on the 60 acres. No, you can decide what you want to do with the 100 acres. You want to sell them, you want to renovate them, you want to construct a factory. You can decide what you want to do. However, you are having a 60% stake, so if the asset is sold and the money is distributed as dividend, yes, 60% of that will come to you, 40% will go to someone else. However, you can decide what you want to do with the entire 100% of the assets. Sir, why are we discussing this? Because AS 21, the way it gives consolidation procedures is, it says that all assets and all liabilities have to be consolidated. That is for the balance sheet, all revenues and all expenses also have to be consolidated, and this is done at 100%. So 100% of the assets, 100% of the liabilities will be consolidated irrespective of the fact that you own a 60% stake or a 100% stake. Sir, why? Because you have control over the assets. You don't have control over just 60% of the assets. You have the ability to direct and take decisions on the entire 100% of the assets, and hence consolidation happens on a full consolidation basis, on a line by line basis. Each and every line item of the subsidiary is consolidated with that of the parent. The first important point. Second, well, you are consolidating 100% of the assets, but if these assets actually get sold and money is distributed as dividend, the entire 100% does not go to you as a parent. In fact, 40% will go to outsiders. And as a result, it is important to create a separate account called as minorities interest account, also called as non-controlling interest accounts, in the books of the subsidiary. Now, this is very much the concept that gives birth to the minorities interest is the fact that you have to consolidate 100% of the assets even if you own the 60% stake. So that is why you have to give a 40% share in those assets to someone else, which is called as a minorities interest, and this minorities interest is shown as a separate line item between the shareholders' funds and the non-current liabilities. So assets and liabilities are consolidated. The part of the assets which is not held by the parent is to be shown as minorities interest. Okay, what do you do with the share capital? What do you do with the reserves? And what about the investment in, let us say, Jio, that appears in the standalone books of Reliance? Achha, it is quite clear that if I consolidate all assets and liabilities of Jio, I will not again show the investment in Jio in my consolidated balance sheet. Otherwise, that will result in double counting. That investment gives me access to those assets and liabilities, and if I am showing those assets and liabilities, I will not again show the investment, and hence investment has to be eliminated. Okay, if I say eliminated, it means if investment has a debit balance, I need to credit it. Okay, so what will I debit? Well, I can open a separate account or do a separate working in something called as cost of control. So I can say that, okay, all assets and liabilities consolidated, investment has to be eliminated. So cost of control account debit to investment. So I will kind of eliminate the investment. Okay, but in the subsidiary, you also have the share capital and the reserves. So the investment over here is exactly in the shares of the subsidiary. It is like in amalgamation, you have debtors in one books, creditors in other books. So if these debtors and creditors are of the, same party. So if the purchasing company had the selling company as a debtor and the selling company had a purchasing company as a creditor, these are renter company. You will eliminate it. In a similar way, investment is in the equity shares of the selling company, and then in the selling company, you have the share capital, which is nothing but those exact shares. And as a result, when I eliminate the investment, against the investment, I also eliminate the share capital of the subsidiary. So I might have invested out of the 1000 shares in the subsidiary, I might have invested in 600 shares, and I might have invested, let's say 750 rupees to buy those 600 shares. Yes, so these 600 shares are eliminated. However, the selling company has 1000 shares. Well, 600 of them are attributable to the parent, the remaining 400 are attributable to the minorities. So 400 of those shares will appear as minorities interest. And once you have done all of these, you have to remember that you have kind of taken the subsidiary's entire assets and liabilities, consolidated them, share capital, you have eliminated it. But then is there anything else? Yes, there are reserves in the subsidiary. To whom do those reserves belong? Well, they belong to the shareholders, and the shareholders can be the parent to the extent of 60% and minorities to the extent of 40%. Okay, so will all the reserves directly be consolidated? The answer is no. The law says that reserves which are in existence pre-acquisition are like capital profits and they should not be consolidated and they should be eliminated, whereas the reserves which are in existence after the date of acquisition are due to your management, your efforts, your time, and as a result they can be consolidated. So what you will do is you will look at the reserves in the selling company's balance sheet. For example, there is a general reserve or a profit and loss of 1000, and in the adjustments you will be told that as on the date of acquisition these reserves were 400, in which case we will say that, okay, out of this 1000, 400 is pre-acquisition, which means the remaining 600 is earned post-acquisition. For the 400, it must be existing as on the date of acquisition, and I guess you should be aware that when I take a stake in a newly incorporated company, I will not really pay a premium. I would say jitna share capital hai, utna hum pay karenge because you are giving me nothing else. But if there's a company which is in existence, then apart from the share capital, I also get access to the reserves. These reserves actually belong to the old shareholders. It was earned during the period when they were the owners, and if I am acquiring a stake over there, these reserves come to me. So these old shareholders are not going to give these reserves free of cost, and hence a part of these reserves you will have to pay in the form of a higher purchase consideration. So the standard kind of believes that the pre-acquisition reserves are not earned by you. In fact, they are purchased by you, and a part of that purchase price is in the PC that you have paid, in the investment account. Whereas the remaining reserves which are earned after acquisition are during your regime, and as a result they belong to you and hence should be consolidated. So the rule over here, and we will follow a few steps, the rule over here is that all assets, all liabilities of the subsidiary fully consolidated, minorities interest created for the assets and liabilities to the extent of the share that is held by outsiders, investment appearing in the books of the parent will be eliminated against the share of equity share capital of the parent as well as the pre-acquisition reserves of the parent. Post-acquisition reserves, you have to remember, are going to be consolidated. So the parent gets a share in the post-acquisition reserves, the minorities also have a share in the post-acquisition reserves. And using these consolidation principles, the features of consolidation which we have just discussed, we prepare consolidated financial statements. So these 5 steps over here, or the 5 features we have outlined, is what I have just discussed. Acha. Now what is the process? What are the steps in the consolidation process? Well, you can follow any steps, and different professors and different students have different ways of solving. As long as you come to the same final answer, no problem. Step number 1, you prepare the format of the Schedule 3 balance sheet. Don't write the numbers, but prepare the format. Shareholders' funds, share capital, reserves and surplus, minorities interest, then all the items which are there in the balance sheet. While preparing the assets, you will also prepare intangibles which will have goodwill, and you prepare the blank format. After that, you prepare the notes to accounts, and in the notes, you will write down exactly the assets and liabilities as they are appearing. No adjustments. So you will start with note 1, share capital, which will be the parent share capital. Note 2, whatever are the reserves, you will write down the reserves and keep them blank because you will have to do some calculations. And then from note 3, trade payables, long-term loans, PPE, inventories, debtors, creditors, H limited, S limited, H limited, S limited, wherever there are adjustments. For every adjustment in a particular item, leave around 3 lines. So if there are 2 adjustments, leave 6 lines. If there's 1 adjustment, just leave around 3 lines and then go to the next part. So you write down all assets and all liabilities. The only thing that now remains is investment in the books of the parent, the reserves in the books of the parent, the reserves in the books of the subsidiary. Then you prepare 3 important working notes. Working note 1 is on consolidated reserves. You'll write down working note number 1, consolidated reserves, something like that. And then jitne bhi reserves hai, you will put that in columnar form. General reserves, securities of premium, profit and loss, you will put them in columnar form. Remember, you will start with the parent's reserves as they appear, and to that you have to subsequently add the subsidiary's reserves. So you will start with standalone parent. Whatever are the reserves appearing in the parent's balance sheet, you will write that down over here. Then you will prepare 2 working notes. You can prepare them as ledgers, or you can prepare them as statements. Institute usually prepares a statement, so you can prepare that as statement. Otherwise, you can even prepare a ledger where you will prepare, let us say, the cost of control. So the working note 2 over here will be on the cost of control. If you are preparing in a statement form, then it will appear as investment. So whatever is the investment will appear over here. And with that, you have taken everything in the parent's balance sheet. Leave around 8 lines, and then working note 3 will be minorities interest. This investment will be eliminated against the parent's share in the subsidiary's net assets. However, we don't have the net assets as on the date of acquisition. Acquisition might have happened in 2011. We are now in 2013. But we might have information to find the net worth as on the date of acquisition. You might be given the reserves as on the date of acquisition, and hence typically we adjust this against the parent's share in the net worth of the subsidiary. Like net assets is assets minus liabilities, net worth is share capital plus reserves. Ultimately it gives you the same final number. Over here you will take the equity share capital. So if there are 1000 shares, out of which 60% is held by the parent, so 600 will be taken over here, whereas the remaining is attributable to minorities, so 400 comes over here. by this point, the process will ensure that the only thing that remains is the reserves of the subsidiary and the adjustments which are given below the balance sheet. So you have to ensure that you prepare the Schedule 3 balance sheet format, write down all assets and liabilities, prepare the 3 working notes, the most crucial parts, prepare the 3 working notes, and then goes the heart of the question where you have to analyze the reserves. So for example, over here, reserves belong to the parent and subsidiary, reserves belong to the parent and minorities, and reserves have to be analyzed between pre and post, because if it is pre-acquisition, then the parent share will go in working note 2, that is COC, whereas if it is post-acquisition, the parent share will go in working note 1, that is a consolidated P&L. So the question might give you data, and again we can do it in a chart form, or we can kind of prepare a table where you can say that okay, there is total, there is pre-acquisition, and then there is post-acquisition. So you will have the balance given. For example, the balance given is 1000, out of which the question says 400 is pre and the remaining 600 is post. Okay, so this is accordingly you will prepare that. Then there would be space left for certain adjustments which you will study in some time, like the fair value adjustment, upstream or downstream inventory adjustment, dividend adjustment, etc., where you will do some adjustments and find the adjusted balance if required, and that adjusted balance belongs to the parent and minorities both. So for example, in this case, if there are no adjustments, then this is the balance which is attributable to parent 60% and minorities 40%, in which case 400 into 60 will be 240, 160, 360 and 240. So this 240 over here is the parent share in the pre-acquisition profits, will go in working note number 2, which is cost of control. So for example, over here this is pre-profit and loss, this is 240. For minorities, we don't really care whether it is pre or post, it belongs to the minority. So this is pre-P&L, for example 160. 360 is attributable to the parent, it is earned during its regime. So this is consolidated profit and loss, working note number 1, where you would have started with standalone parent, and to that you add the share in the post acquisition, share in post acquisition S, which let us say is around 360. And lastly, you will have the post acquisition P&L, which is 240. The post acquisition P&L, which is 240, and that if you have given effect to all of these 4 numbers, you have in essence given effect to this 1000 rupees. So by that you have given effect everywhere, and now you can kind of try to take the difference. So if you have invested, for example, 900 rupees, we will say that, well, 9 against the 900 you get share in the net worth of 840, and hence you have paid 60 more, which represents goodwill. Apart from that, in minorities you will take the total, which is 400, 160, and I guess this is 800. So this is the minorities interest, and this is how you will proceed. There can be adjustments, and that is, there will be adjustments. In my opinion, there will be 2 to 3. One may be fair value adjustment, one may be the dividend adjustment, upstream or downstream inventory adjustment, etc. Or very common mutual indebtedness, debtor and creditor. In the parent's book, subsidiary is a debtor, in the subsidiary books, parent is a creditor. So you will have to do those elimination, bills receivable, bills payable, etc. So once all these adjustments are given effect to, you will total up the amount in the notes, post those amounts in the Schedule 3 balance sheet, and pray to God that the Schedule 3 balance sheet tallies. Acha, so this is the process, but along with the process for preparing the consolidated balance sheet, you have to be cognizant of the adjustments. There are around 5 or 6 adjustments, out of which I would reckon 3 of them are the most important and full-fledged questions. First is an adjustment where the minority's interest sometimes goes negative. So typically, when there is a profit pre or post acquisition, the profit belongs to parent and minorities both. However, in certain cases there might be losses. Well, losses also belong to the parent and minorities both. So we will allocate the parent share of loss to the consolidated P&L and the minority share of loss to the minorities interest account. This will keep on happening, but in certain cases the losses might be so huge that might in turn make the minorities interest negative. For example, hypothetically, if subsequent to this there are huge losses to the tune of 900, then minorities interest is 800 only. They will not become negative. I mean, in a sense, if they do become negative, that means the minorities interest will have a debit balance, which kind of means that you have 100 receivable from the minorities. However, as per the limited liability principle, once the shareholder has paid amount to the extent of it, the face value, you can't recover anything beyond that, and hence the minorities would say that we are not going to pay that 100, and hence showing that 100 as a debit balance as a receivable will be wrong. So minorities' interest will be restricted to 0. It will not go beyond 0. However, if the parent is fairly confident about the subsidiary and wants the subsidiary to continue the going concern, then the loss which is not borne by the minorities will have to be borne by the parent. So that 100 which is not being borne by the minorities, that 100 over here will have to be borne by the parent. Acha. So if the minority is not bearing its loss, because it will in turn result in a debit balance, then parent will have to be bearing the share of that loss. That 100 will go in the consolidated P&L along with the parent share of losses. Now in the future, tide might change, and now let us say the subsidiary is making a profit, then again a part of that profit is attributable to the parent, a part of it is attributable to the minorities. But the moment the minorities take a claim on the profits, the parent would say, well, you know what, 100 of that profit we have borne, 100 of the loss we have borne, which was your loss, and hence you will be allocated profit only after adjusting that 100. So there have been questions in the past, and you would have also done a sum on this, where the institute has dedicatedly asked you a 5 or a 10 mark question where you are supposed to calculate the minority interest in cases where there are losses. So you will stop allocating losses to the minority the moment the minority becomes 0, and then do a separate working to calculate the cumulative loss that the parent is bearing on behalf of the minority. The moment there is profits, the minority share of profits will be taken by the parent till the time the entire loss borne by the parent has been offsetted, after which the working flows as usual. I would recommend you refer those questions. I think it was even asked in the May 18 exams. Aja. Second is a fair value adjustment, which is important, and I reckon it has come in every exam where there's a full-fledged balance sheet, so this is definitely important. When you study AS 14 or even AS 21, ideally, when you acquire a business, you take over the assets and liabilities at fair value. In AS 14 amalgamation absorption questions, that happens by default because the selling company closes, and hence you take over the land, building, etc. of the selling company at fair value. The problem that arises in a consolidation question is that the selling company does not close. So yes, Tata Motors might acquire 100% stake in JLR, but if JLR does not close, JLR will continue preparing its financials, and JLR will keep on recognizing its fixed assets in its individual books as per AS 10, using historical cost, using inventory, using AS 2. Merely because someone has acquired my shares does not mean I revalue all my assets and liabilities in my individual books. For JLR, it is just a change in the register of members, it is a change in shareholding. The company still continues its separate legal existence, and hence JLR will not revalue its assets and liabilities in its individual books. However, Tata Motors would have paid, for example, the consideration based on fair value, irrespective of what is appearing in the books. So, for example, JLR has a land worth 100 rupees in its books, whose fair value is 500. If Tata wants to acquire 100% stake in JLR, it will have to pay at least, if not more, 500. Now, if it pays 500 and I take over land worth 100, it kind of shows that the additional 400 I've paid probably is attributable to the goodwill of JLR, which is wrong. The additional 400 here is not attributable to the goodwill, but to the fair value of the land which was existing on the date of acquisition. Sir, but JLR has not remeasured it. Okay, JLR is not required to remeasure it because it applies its AS10, AS2, etc. However, Tata Motors, when it acquires this, Tata Motors has effectively paid 500 for that land, and hence Tata Motors should ideally consolidate the land based on 500. And hence you will have to make an adjustment. Where land in a way is debited, you will have to increase the land by 400 and credit reserves. Now you can call it as fair value reserve, revaluation reserve, or like what Institute does, call it as profit and loss. Because at the end of the day, these reserves are in existence as on the date of acquisition. That 400 is the appreciation that has happened up to the date of acquisition, and hence that 400 will be taken as a part of pre-acquisition profits, and in any case you do not consolidate pre-acquisition profits, you eliminate it by transferring it to the cost of control or the minorities, and hence whatever the name you give, it is fine. We typically adjust it in the profit and loss. So if let us say there is a 400 adjustment, we would say that okay, before we do any of these allocations between parent and minorities, we would do certain adjustments. And in this adjustments, you will say that, okay, there is a fair value adjustment whereby 400 is an increase which was there as on the date of acquisition as well, and hence 400 will increase over here. And when in the notes that you prepared for land and building, you must have said H limited, S limited, जो भी total आ रहा है यहाँ पे we will say plus fair value adjustment to this to the extent of 400. So both effects are given. Now if it is land, the story ends over here. However, if it is something like building which gets depreciated, let us say this is a building and the life of the building is 10 years from the date of acquisition. So the subsidiary would have depreciated the building at the rate of let's say 10 rupees. 100 divided by 10, that is 10 rupees. However, the parent has shown this building at 500. So the depreciation ideally for the period after the acquisition should not be just 10, it should actually be 50. And hence you will have to make an adjustment for the depreciation. In the consolidated accounts, the depreciation after the year, after the date of acquisition should actually be 50. However, the subsidiary has recorded only 10 and hence an adjustment will have to be done for 40. Now, due to this 40, the building will reduce by 40. Okay, so you will create the building, but then what will you debit? Well, the profits after the date of acquisition will be debited, and these are post profits. So for example, over here, due to the depreciation, whatever are your post profits will reduce by 40. But at the same time, your asset will also reduce by 40. What that will rightly do is, the asset which was at 100 minus 10, that is 90, probably in all likelihood, in the selling company's books a year later, this will appear at 90. Say the asset was appearing at 90, that is 100 minus 10. We would say that, okay, in the consolidated books, it should appear at 500, but that 500 will get depreciated. And hence ideally a year later, it should appear at 450. If you go to see 90 plus 400 minus 40, will actually land up to 450, which is a value that should appear in the consolidated balance sheet. So this is a fair value adjustment. You have to be careful that you compare the WDV as on the date of acquisition with the fair value as on the date of acquisition in order to correctly find the adjustment for the fair value to be done. If it is a depreciable asset, then adjustment for depreciation should also be done. If you can't digest it as well, just remember that the adjustments to fair value as on the date of acquisition will always be pre-acquisition profits adjustments, whereas the adjustments for items after the date of acquisition like depreciation will always be adjustments after or post the acquisition. Okay, this is the general rule, we have mentioned that. Now in certain cases what might happen is parent might sell goods to the subsidiary, subsidiary might sell to the parent, and there might be debtors and creditors. So if there is any unpaid amount or an amount yet to be received, debtors and creditors will appear in the balance sheet, which needs to be eliminated, and hence debtors and creditors will be eliminated. Intercompany elimination, like you do even for amalgamation, nothing much over here. However, in certain cases what might happen is the parent might sell goods to the subsidiary and subsidiary might not be able to sell these goods to the outsiders. So parent might sell goods which are having a cost price of 100 to the parent at a selling price to the parent of 120, and hence parent might recognize a 20 rupees profit. Subsidiary might not have sold these goods to the outsiders, and hence in the subsidiary's books these inventories will appear at 120. When I join the two, what will happen is in my consolidated P&L, 20 will continue to appear as a profit from the standalone P&L of the parent, and inventory will appear at 120. Now this is against prudence conservatism as well as AS2, where inventory is not really appearing at cost. Your real cost for the inventory for the group as a whole is 100, but it is appearing at 120, and 20, well, in the individual books it is recorded as profit, which is correct because P and S are separate legal entities, but the moment you prepare consolidated financial statements, P and S are one and the same, and as a result the 20 should not appear. So we will eliminate it. Achha, eliminate it from where? Well, this 20 of profit is in the books of the parent, and parent's profits are recorded in working note number 1. When you prepare consolidated P&L account, so we will reduce the consolidated P&L working or the P&L of the parent by 20 rupees, and the second effect will go against the inventory workings where you will reduce 20. Sir, is it possible that subsidiary has sold 50% of it to outsiders? Yes. If yes, then the subsidiary's inventory will appear at 60, half of 120. Elimination will not happen for the entire 20 of profits because half of the goods have actually been sold to outsiders, and hence the elimination will be only for the remaining half. That is 20 rupees of profit into 50%, that is 10 rupees will be eliminated against the inventory as well as against the profits. Okay. Now when we are looking at that, these are called as downstream transactions. The same logic also applies if the subsidiary were to sell goods to the parent. However, in this case, the profit will be sitting in the books of the subsidiary, and the profits of the subsidiary do not directly go to working note number 1. No, they actually go to working note number 4, where they are analyzed between pre and post, and hence you have to figure out whether this sale has happened in the pre-acquisition period or post-acquisition period. If nothing is given, institute always assumes that the sale has happened in the post-acquisition period. However, you have to look at the date of sale if given and then decide whether it is in the pre or post-acquisition period. So you will remove it from the profits of the subsidiary, let us say from the post column if it is in the post-acquisition period. Sir, how does it matter? Well, the profits of the subsidiary belong to parent and minorities both. And hence, if you are adjusting it from the subsidiary's profits in working note number 4, a part of this will probably also affect the minority's interest. The second effect will still go in the inventory. This is an important treatment. Again, we have mentioned it as important. Similar adjustments are also possible in case there are unrealized losses instead of unrealized profits. So unless, parent and subsidiary is one and the same, so you might actually sell goods between the parent and subsidiary at a nominal value. NRV might be higher, net realizable value, but you might sell it at, let's say, 10 rupees. So there might be some unrealized losses. For the group as a whole, there is no real loss unless the NRV has fallen, and hence, like you eliminate unrealized profits, you will also eliminate unrealized losses. This similar adjustment is also possible if there is an upstream or downstream sale of PPE, property, plant and equipment, where we have, let's say, sold land or sold a building. The same treatment will happen. The profit in the books of the company selling will be eliminated, and the cost in the books of the purchaser will be reduced. However, here there may have been subsequent depreciation as well. So I might have sold building of 100 at 120, and the subsidiary company might have depreciated the building based on 120. Well, for the group as a whole, the building is really worth 100, and hence you will eliminate the 20 of profits, but then the subsidiary might have depreciated the building based on 120, that is 12 rupees per annum. Ideally, the depreciation should be 10 rupees per annum, and hence the 2 rupees per annum of depreciation which has been charged may also need to be reversed at that stage of consolidation. This is something that you'll have to practice over here. We just have to revise. I hope you understand. You're not listening this as a first reading. It is obviously after you have done consolidation or you are in the process of doing it. And the third important adjustment is the dividend adjustment. A lot of adjustment questions do take that into consideration. Dividend is the only place where it kind of reduces the profit after the date of acquisition. So it might happen that the balance as on the date of acquisition, that is, let us say 1st of April 2020, for example, is 1000. The profits which are earned during the year 2021, for example, are 500, and then dividend is paid. Now what dividend does is it reduces the profit. So dividend is paid, let's say in the middle of the year somewhere, date is given of, let's say, 300, and hence the profits available now, the P&L balance now is, I think, 1200. Now 1200 can't be said to be fully pre, it can't be said to be fully post. Let us say the date of acquisition was 1st of April 2020, in which case the balance as on 1st April 2020 of 1000 will be pre, the profit of 500 will be post, but dividend, it depends from which source has the dividend been paid. If nothing is given, we'll assume that the dividend is paid out of the profits of the year for which it is paid. So if dividend is paid out of 2021 profits, then dividend is also post acquisition. It is paid out of this 500. However, if dividend is paid out of the opening balance which existed on 1st April 2020, then dividend is paid out of the pre-acquisition profits. Okay, the question will typically tell you whether it is paid out of pre-acquisition or post-acquisition, and accordingly you will have to do the working. So if it is paid out of pre-acquisition, the working will be, okay, the total is 1000 plus 500 less 300. Okay, so we'll say 1000 is pre, 500 is post, and this 300 will be reduced over here. Okay, so we will analyze 700 and 500 and solve. However, if dividend is paid out of the post acquisition profits, then this 300 will be taken over here. Okay, so sir, do we have to do any separate adjustments? Well, if the subsidiary has passed the entry, then nothing to be done on your end. But if subsidiary has paid the dividend, the parent would have received the dividend. And ideally, if I apply AS 13, Accounting Standard 13 investments, if dividend is paid out of the pre-acquisition profits, then it should be reduced from the cost of the investment. So the entry should have been bank account debit to investment. And if dividend has been paid out of the post-acquisition profits, then it should go to the P&L. The entry should be bank account debit to the profit and loss account. Invariably, in almost every question or every big question that I've seen coming in the exam, what happens is dividend is actually paid out of the pre-acquisition profits, and the institute tells you that the holding company is erroneously taking it to the P&L account, which means there's an error, and before you do any detailed consolidation processes, you have to rectify that error. Okay, so what is the error? Well, you have credited the profit and loss of the parent, which appears in working note 1, and the investment which appears in working note 2 is also not correct, because I mean it should be the investment after reducing the pre-acquisition dividend, and hence a rectification entry or a rectification adjustment can be passed whereby you debit the P&L of the parent by the pre-acquisition amount and you credit the investment by the pre-acquisition amount, and once you do the adjustments, solve usually and your answers will tally. If the parent has correctly reduced the investment, no adjustment to be separately done, do the working usually and your balances will tally. So this is typically about dividend. Preference share capital has not really come as such in your main exams or anything, but it is there as a small theory note, and there is one question in the November 18 or so RTP which involves preference shares. Remember, preference shares are also owners. Like there might be certain owners. I mean, preference shares don't probably give you control, they don't give you voting rights, but at the end of the day, they are owners. Even when you look at amalgamation AS 14, payment to equity as well as preference shares, both are taken as a part of PC. So preference shares, though they may be similar to debentures like liabilities, however, they are also owners. And hence, if there are preference shares in the selling company, then how do we account for them? Okay. We should ask the question, have we acquired those preference shares or not? Well, let's say no, we have not acquired it. Achha, is it compulsory that we have to acquire all the equity shares in the selling company? Well, no. There might be 1,000 shares in the selling company and we might have acquired 800. Then what do you do with the remaining 200? Well, these are owners of the selling company which are not acquired by the parent, and hence these are shown along with minorities. In a similar way, if there are preference shares and these preference shares are not acquired, and these preference shares are not acquired by the parent, then this preference share capital will appear along with the minority's interest. While you are attributing profit, you have to remember that you subtract the preference dividend, because the profits available to the parent's equity shareholders as well as a minority equity shareholders will be after paying preference dividend. So basically, if typically, rarely preference shares are not important, but if they come, the preference shares will typically, if they are not acquired by the parent, then they will appear along with the minorities. If a part has been acquired, then your investment will be the investment in equity shares along with the investment in preference shares. Like you take equity share capital, the part of preference share capital will also be taken in the control. Okay. Next we have bonus adjustment. Again, not something which is particularly important, and over here, if there is a bonus should again be given. It's like an appropriation. It is like dividend goes from shareholders to shareholders. It's from the company which belongs to the shareholders in the hands of the shareholders. Even bonus is an appropriation. You can debit the share capital. Sorry, you can debit the reserves which belong to the shareholders and credit the share capital. So one particular thing that you have to be extremely careful while you do bonus is you have to be careful of the fact that bonus can kind of make your stake calculation particularly tricky. So the question in the notes might tell you that on 1st April 2020 we acquired 180 lakh shares, and then on 1st July a 1:1 bonus is given. Okay, so remember the balance sheet of the subsidiary is as on 31st March of the next year. So subsidiary in its books might have taken the effect for the bonus, And hence what you might typically do is you might take that, okay, we have acquired 180 shares and divided by the share capital that is appearing in the subsidiary's balance sheet. You are not comparing apples with apples. The 180 shares that you see in the adjustments are pre-bonus. On that 180 you have also received bonus, but the shares of the subsidiary that you see in the balance sheet are post-bonus. And hence you have to be extremely careful to calculate the stake by either comparing the pre-bonus number of shares acquired by the parent with the pre-bonus share capital, or comparing the post-bonus number of shares held by the parent with the post-bonus share capital. That will give you the right stake. Acha, bonus ke question mein you can also get dividend. Now a question will arise that will dividend be paid on the bonus shares or not, depend also on the date. If the bonus is on 1st of July but the dividend was paid on 1st of May, then bonus shares were not in existence. How will they get dividend? But if bonus was on 1st July and dividend was paid, let's say 31st March next year, then in all likelihood dividend will also be paid to the bonus shareholders. Data will be given in the question. And lastly, like, we have to figure out whether dividend is out of pre-acquisition profits or post-acquisition profits. Bonus also has to be figured out on whether bonus is out of pre-acquisition profits or post-acquisition profits. If nothing is given, we will always assume that the bonus comes out of the pre-acquisition profits, because bonus is nothing but capitalization of reserves. So ideally, if nothing is given, we will assume that the oldest reserves are capitalized first, and hence bonus is assumed to come first out of the pre-acquisition profits. Okay. Now that is a bonus adjustment, not as important. If bonus is out of pre-acquisition profits, then you will reduce the pre-acquisition reserves. If it is out of post-acquisition profits, then you will reduce the post-acquisition reserves. The share capital over here that you need to eliminate will be the share capital appearing in the subsidiary's balance sheet, which will be the share capital after bonus. Achha, next you have an adjustment on uniform accounting policies. You don't get that as a part of full-fledged consolidation question, but there has been a question that has come in the past exams whereby the institute has given you a subsidiary's balance sheet and it has given you the policies that are followed by the subsidiary and parent. Now, if I am consolidating, ideally the policies of the subsidiary and parent have to be uniform. I mean, in the individual records they can be different, but when I consolidate, I can't have some of the inventory as per FIFO and some of the inventory at weighted average. If it is the same item of inventory, it has to be using the same principle. And as a result, if different accounting policies are followed, then the subsidiaries' financials will be restated to bring them in line with the parent's accounting policies. Like parent might have followed FIFO, subsidiary might have followed weighted average, then the subsidiary's inventory will be restated as per FIFO. So inventory will increase, and at the same time the second effect will go to the reserves. So if the inventory increases, I mean closing stock is typically, loosely speaking, credited to the trading account, and hence the profit should also increase. Or the parent might may not make any provision for bad debts, but the subsidiary has a policy of providing 1% as provision for bad debts. Well, parent does not do that, so you will reverse that provision. So your debtors will increase and at the same time your reserves will increase. There might be certain major advertisement expenses which the parent writes off in one shot. Subsidiary or the other company spreads it over 3 years. Well, then whatever is not yet expensed off should be expensed off. You will reduce the prepaid expenses and probably show that as an expense. This can be different items, but you will have to restate the subsidiary's balance sheet to bring it in line with the parent's policies, and then the restated balance sheet will be used for consolidation. Next is different reporting dates. Typically, the consolidation should happen based on the parents and the subsidiary's balance sheet, which are at the same reporting date. However, if the reporting dates are different, then you will have to restate the subsidiary's balance sheet as on the parent's balance sheet date. Achha, but then finalization is a time-consuming process. I'll have to do the entire finalization process again, which is cumbersome. So the standard over here gives a leeway. It says that if the gap between the parent's financial statements and subsidiary's financial statements is less than 6 months. So for example, you have a foreign subsidiary who has a 31st December year ending, you have a 31st March year ending, the gap is 3 months. Then rather than subsidiary accounting for all the adjustments during the 3 months and again preparing the balance sheet, the standard says that you can make only adjustments for material transactions. Material transactions will be identified by the management and given to you in the question, like there's a big loss by fire, or if there's a major asset acquisition, or there's a major, let's say, share buyback or whatever it is, those transactions will be given to you, and you will just give effect to those transactions and prepare a draft financial statements of the subsidiary as on 31st March and then do the consolidation. However, if the gap is more than 6 months, then such material adjustments alone will not do. You will have to account for all the adjustments and prepare a full-fledged balance sheet. Acha, so these are the key adjustments. Sometimes the question asks you only to calculate the goodwill or the capital reserve, as the case may be, which is done usually in a consolidation question by comparing the investment made with the parent's share in the share capital as well as the pre-acquisition reserves. However, the question in some cases might not give the parent's share in the share capital and may not give any data about what the reserves were as on the date of acquisition, but instead of that it might give you details about assets and liabilities. Well, this is then very similar to an amalgamation question where you compare the investment or the PC with the net assets taken over. In a similar way here, you will compare the PC, that is the investment, with your share in the net assets taken over. This is because it is not necessary that you, like in an amalgamation or absorption, you will always have 100% stake because the selling company has to close. But here that is not necessary. You might actually acquire only an 80% stake, and if only 80% stake is acquired, your investment or piece is only for an 80% stake, so you will have to compare that with only 80% of the net assets. Net worth and net assets are one and the same. You will take the net worth, that is share capital or reserves, or if that is not available, you will take the net assets, that is assets minus the liabilities at the fair value as on the date of acquisition, your share of the assets or liabilities. Okay, so that is an alternative method to calculate the goodwill or the capital reserve. And the last part, for which there have been a question or so which have also come in the exam, is on consolidated profit and loss account. Typically the question gives you details about the consolidated balance sheet. But what if the statement of consolidated profit and loss is asked? Like you consolidate assets and liabilities, here you consolidate the revenues, you consolidate the expenses, you consolidate the incomes, you consolidate the costs. So over here, the consolidation will still be 100%. So all the revenues, all the other incomes, all the cost of materials, all the employee benefits expenses, depreciation, finance cost, everything will be consolidated. You get the profit before tax. The tax expense will be consolidated. You get the profit after tax. Now, this is a fairly easy working. The only adjustments that can potentially come over here will be intercompany elimination of sales and purchases, of probably consultancy fee given by the parent to the subsidiary and the expense recorded for that, or any other intercompany items. Apart from that, there can be unrealized profit in stock, and if you see a changes in inventory, then the stock in that would be based on the old inventory values. If there's any unrealized profit, that needs to be eliminated. One effect will come in the consolidated profit and loss, the second will go in the inventory in the balance sheet. Now in certain cases, the question might ask you to go further and show the attribution, in which case the profit after tax is a consolidated profit. Institute study material question ends over here, but the July 21 question, which is a more interesting one, goes further. It kind of says that, okay, how much of this profit is attributable to minorities? Well, one would say whatever is a consolidated profit into, let's say, 30%, if it is a minority stake, will be minorities. Wrong. The consolidated profit includes the profit from the parent's financials as well as the subsidiary's financials. You will have to separately find out how much is the profit in the subsidiary's financials, and uska 30% will attribute to the minority. So we will attribute a part to the minorities. The remaining will be attributable to the parent. However, it might happen that the acquisition might have happened somewhere in the middle of the year, in which case the entire profit of the subsidiary will not be attributable to the parent and will not be consolidated. A part of that profit has to be adjusted against the cost of control. So if the profit was 1200 rupees for the entire 12 months and the acquisition happened after 6 months, then the first 3 months profits, that is 300 rupees, is pre-acquisition. Well, the parent stake might be 70%, and 300 into 70%, that is 210, will be reduced. It will not be taken to the consolidated P&L account ultimately in the balance sheet. In fact, that 210 will be adjusted against the cost of control in order to calculate goodwill. Only the profit in the remaining 9 months, that is 900, will be attributable to the parent and the minorities in the post acquisition. So 900 into 70% will go in the consolidated P&L, 900 into 30% will go to the minorities. the profits in the pre-acquisition period, 30% of that can still go to the minorities, but the 210 which is attributable to the parent will be reduced. So these are the two adjustments where you have to be particularly careful about. Other than that, it is a fairly easy working. In fact, it is a lot more easier than the consolidated balance sheet. So I guess that should be it. There is also consolidated cash flow, in which case you will join all the cash flow items, but there is no full-fledged question in the study material, but if it comes, you are going to consolidate each item of the cash flow like you do in the consolidated P&L account. Intercompany cash flows will be eliminated, but other than that, you will consolidate the cash flow items. So that largely takes care of the consolidation. This is something that you have to practice on pen and paper, at least a few questions, in order to get a hang of the flow. And once you do that, it is not as difficult. It is a process-driven question. आपको starting का जो पूरा part है, up to working note number 3, it should be clear in your mind on how you are going to go through, and then you have to apply your mind when you do analysis of reserves in working note number 4 and solve. A couple of points that I now remember are, if the question tells you that the acquisition happens in the subsidiary at the time of incorporation, then all the profits are post, because at incorporation there are no profits. Then everything is post. That is one thing that you can kind of remember, and I think that that kind of takes care of most of the adjustments. If you think you have missed out something, please do let me know. If you have any queries, again, please feel free to contact us. And that should be it. If you like the video, please do like, share and subscribe to our channel for more such updates. Wish you all the very best and see you soon with other videos. Bye bye. Take care.